The S&P 500 forward PE ratio is now at highs that we have not seen since the dot-com bubble, if you exclude the 2020 pandemic blip, surging to 22.7. And Warren Buffett's favourite valuation indicator, the total stock market value to GDP ratio, makes the market bubble look even worse, as this indicator has now reached a staggering 205%, eclipsing any previous highs that we have seen in previous bubbles. That means that we are higher than the peak of the dot-com bubble, where the S&P 500 went on to fall over 49%, and also higher than the 2021 market bubble, where the S&P 500 fell 24% in less than a year. And this indicator is even dubbed the Buffett indicator, as he has said before, it is probably the best single measure of where valuations stand at any given moment. As well as this, there are also a number of very concerning signs about where the fuel for this market rally is actually coming from, and retail investors are responsible for an ever-growing percentage of total trading activity, which has now reached 20%. The last time that retail investors had this large of a share of trading volume was back during that 2021 market bubble mentioned earlier, which was a crazy post-pandemic market where there was a big SPAC and meme stock craze amongst retail investors. And we are starting to see similar signs of this madness during this bull run cycle, with retail investors buying into more and more unprofitable speculative names that are being hyped up. The Goldman Sachs non-profitable tech index has been surging vertically since April and is now up 66% since these lows, now at the highest that it has been since 2022 before a big market correction. And recently we are now even seeing extremely low quality stocks that are down close to zero and on the verge of bankruptcy surging in retail driven frenzies, including names like Opendoor, GoPro and Krispy Kreme. And on top of all of this, we have just seen the craziest IPO day for a long time with Figma, where the share price opened at $33 and surged over 250% to over $140 per share on the very same day, likely fueled by a retail frenzy. And what makes this more concerning is that they seem to be taking on an increasing amount of leverage, with total US margin debt now surpassing $1 trillion for the first time in history. As a percentage of GDP, this is the second highest level that it has been at in history, behind the peak only seen during the 2021 bubble. We've also seen retail investors' share of the options market just hit a new record of 21% after surging 5% since April, now exceeding the 2021 peak. So we are in a situation now where we have retail investors piling more and more money into the market, often into low quality, unprofitable companies, and also increasingly using leverage to do so by either increasing their margin debt or using options instruments. This is clearly a big red flag to how inflated the market is right now, and a very frightening signal of where things could be about to go. But while retail investors are going heavier and heavier into stocks, it does appear that institutional investors, often considered to be where the smart money is, are pulling away from the stock market and being more cautious about their exposure to it. Bank of America Global Research finds that institutional investors have been selling on average $2 billion in stocks and ETFs a week throughout July and the end of June, while hedge funds were more neutral. Meanwhile, retail are buying a large portion of these sales and have in fact now been net buyers for 30 out of the last 32 weeks. And perhaps an even bigger indicator of what smart money is doing is by looking at insider transactions to see the buy to sell ratio of those executives who are actually at these companies and know more than anyone else does. At the moment, this insider buy to sell ratio is sitting at 0.25, which means that insiders are selling a lot more stock of their own companies than they are buying. And historically it is a bearish indicator, as it indicates insiders are pessimistic about the future performance or bearish on future stock performance given the current price and valuation. And this includes some large sales from megacap insiders too, such as Jensen Huang selling a chunk of Nvidia stock in recent months, as well as Jeff Bezos selling lots of Amazon stock as well. And Warren Buffett, who we of course mentioned earlier with the Buffett indicator currently being so high, seems to be sticking to his word about this indicator and how overvalued it says the market is right now, continuing to stack cash at Berkshire Hathaway. Now, Berkshire Hathaway's cash pile has been surging over the last year or so, now at $344 billion as of the new earnings report, a gigantic sum that now accounts for a larger percentage of total assets under management than ever before. Berkshire Hathaway is a company that has massively outperformed the S&P 500, so when you see Buffett make notable stock sales in recent time, like Apple and Bank of America, while making no significant buys and stockpiling cash, it is certainly a concerning signal of where the market could be heading. The S&P 500 has historically achieved 12% returns every year on average, so by holding so much cash, Buffett clearly believes that at current market valuations for stocks, holding cash in treasury bonds yielding 4 to 5% on average per year will outperform stock returns. The state of the current economic environment is a key thing to consider as well though when it comes to stock prices, as if the economy starts to boom and earnings begin to rapidly increase, then stock fundamentals could quickly catch up with these historically high valuations that we do currently have. However, there are many economic signals flashing red right now that this is not going to be the case at all, and in fact things could be about to get much worse across the whole economy. Inflation looks to be just beginning to heat up, with the latest CPI numbers coming in hot, above expectations, and continuing to go on an upwards trajectory. The ongoing trade war between the US and many major trade partner countries looks to be escalating as a result of Donald Trump's continued aggressive tariff policies, and we are still seeing new harsh tariffs being set every day. Now, people can argue over who actually pays for these tariffs and whether it is the US and US companies, or if it is foreign countries and their companies. However, the fact of the matter is that the data is suggesting US businesses and consumers are paying for at least some of this. Now, price data from Amazon shows that prices of low-cost goods have surged by 5.2% on average in just a 5-month period between the 20th of January and the 1st of July. And we are also seeing a re-acceleration of US money supply growth, which is another forward-looking indicator of where inflation is heading. As can be seen here, there is a strong correlation between the M2 money supply growth and CPI, with CPI lagging behind by about a year, further suggesting that inflation is about to see a second wave upwards. We've also just had shocking jobs data come in that suggests that the labour market is seeing some major weakness, with the jobs data for July coming in at 73,000 new jobs, 33,000 below expectations of 106,000. And what's even worse than this is that in the same announcement, the previous 2 months of June and May both had massive revisions downwards in number of jobs, with May being revised down from 144,000 initially to just 19,000, while June was revised down from 147,000 initially reported to 14,000. Truly remarkable differences. Now, this combination of job numbers taking into account the revisions now marks the weakest 3-month hiring pace since the pandemic recession in 2020. Now, having inflation on the rise and a job market that is weakening are big red flags for the health of the economy in the future, and we are already seeing things slow down, with new data showing that US spending on services like hotels, air travel and dining have been down for 3 months straight, the first time that this has happened since 2008. Recently, we have seen prominent figures in the financial and investment world, like the CEO of JP Morgan, Jamie Dimon, come out and warn that the US economy could soon deteriorate. He also warned that financial markets are underestimating the risk of interest rate hikes in the US, saying that they are complacent about the mounting inflationary pressure. He does believe that the chance of rate hikes happening during the current cycle are as high as 40 to 50%, whereas the market is pricing in much less. Meanwhile, Ray Dalio, the founder of Bridgewater Associates, is warning that an economic heart attack is coming in the next 3 years if the US doesn't shrink the deficit. This warning comes at a time where national debt is now close to $37 trillion, the interest being paid on this debt continues to rise higher and higher, and the budget deficit continues to get wider and is likely to continue to do so under the new Big Beautiful Bill passed by Trump, according to analyst projections. Now, with all of this being said though, nobody truly knows when the next stock market crash or correction is going to arrive, and there are in fact arguments to be made that we could keep seeing stock prices and valuations rise for a little while. We saw earlier how M2 money supply growth leads to inflation, which is a bad thing for the economy, but it does also lead to asset price growth. So if we keep seeing US money supply and also global money supply grow rapidly as politicians use money printing as a tool to escape the national debt crisis, then we could see the US dollar depreciate even more and the prices of assets inflate massively. We also have AI getting better and better every week, and companies across the entire economy, especially big tech, should be able to utilize it more and more over time to improve business efficiency. Now, this may allow these companies to reduce headcount, improve profit margins, and essentially make more profit without having to actually grow revenue by as much, which will all contribute towards putting downwards pressure on stock valuations, which would be a positive thing for the stock market in general. The US may have bigger concerns overseas in the future too, as China is quietly putting together a master plan to break the US economy and become the next global superpower, and this plan looks to have just entered the next phase. My previous video covers this topic in more detail, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed this video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.